Chris, for kicking us off day 2 with a very warm welcome and reminding us why we are all here and the opportunity that we have to drive change in our businesses and society. I'm very inspired myself. I hope you all are too. Questions for the next 2 panel sessions can now be submitted on the event app. They will remain open until the start of the Q&A session for each panel. We will also welcome questions from the floor during the Q&A sessions, so please put your hands up high so someone from our team can get to you really quickly. We will now have our first panel session of the day, the keynote discussion on mitigation, adaptation, and building resilience. Your host is Dr. Margaret Burnett, the Program Director of the Corporate Environmental Governance Program at the University of Hong Kong. We on campus fondly know her as Dr. B. As we welcome Dr. Burnett and the speakers on the stage, please respond also to the first audience poll for today that will pop up on your device. It is poll 2.2. Please welcome Dr. Burnett and the speakers.
I'll do a little intro first. Morning. Sorry, I have to put my glasses on now. I'm at that point now. Good morning, everybody, and welcome to the first session. I'd also like to say a purposeful hello to everybody on Zoom. I want you to feel welcome and part here with us in the room. I'll just let you know my students are very empathetic right now because we're doing the hybrid or the dual learning mode as well. So welcome to the first session of the day. This session is called Mitigation, Adaptation, and Building Resilience. And we've chosen this since we would like to explore how we can shift the mindset from reacting to risks to a more proactive, action-oriented state of being, whereby we can actually actively seek opportunities. So thinking about, we cognitively, the impacts of climate change are well understood. Our awareness and understanding has significantly grown. We continue to learn of the commercial and financial opportunities for those who invest in adaptation and building resilience. So why then does the gap between awareness and action continue to exist? I want to share some sobering numbers with you. So given that financial evaluations have indicated that the cost of inaction can be upward of 10% of global manageable financial assets, the range is about 7 to 13 trillion US dollars. Also, but since climate change is a systemic issue, and if we add the public sector to this, the financial costs or losses jump to a staggering 30%, or 43 trillion US dollars of the entire stock of manageable assets. We're looking at considerable costs if we do not take action now. So the question then is, how do we amplify the message that there are widespread opportunities to reduce the systemic environmental risks while generating profitability and getting both investors and owners to action on all fronts of mitigation, adaptation, and building resilience? This is our starting point for our conversation today. I won't introduce our distinguished panelists formally, since all that information is captured in the pamphlets. But joining me here this morning, I have Robert from Hong Kong UST and the Now Hong Kong 2050 project, Hendrik from CLP, and Chowny from BNP Paribas. Each are going to give us some insights of the science of climate change, the power sector, and the capital markets. So together we want to start a conversation on what is needed to push for action. And we'd like to encourage that because we're only here for about 45, 50 minutes, this is a very meaningful topic, and we encourage you to continue this conversation for the rest of the day. So thank you. What I'm going to do now is I'm going to hand over to Robert, who's going to kick us off with some insights on the inevitable policy response for climate change. Thank you.
Poll question. I can skip on that, I assume.
I think you're going to need this.
Yeah.
So,
we had a very good introductory video which covers the left-hand half of this slide. Every year, the United Nations Environment Programme does an exercise of comparing where current government policies are taking us in terms of carbon emissions. So the vertical is the carbon emissions, and the horizontal you can see time. And you can see the lines at the top going up, with the highest one being the policies governments were on in 2005, and then coming down, and the red ones being the NDC, National Declared Contributions, added up as to what different countries have said they will do. And then the lines going down is where the carbon emissions need to go to if we are going to stabilize at 2 degrees, 1.8 or 1.5 degrees. And the gap is there and it's growing. And what the United Nations Principles for Responsible Investment have done is done a project where they say, look, it's inevitable sooner or later that governments are going to have to take action to change the policies to stop this gap from growing. Basically, climate change continues to get worse until we get to net zero. Every year that we have net emissions, we are adding oil to the fire. So when's this change going to happen? Going into Copenhagen in 2009, I was involved and all very enthusiastic and thought things were going to happen. So I put my personal money into a clean energy fund. Governments didn't get their act together. I lost some of my money. If you're a business, you want to have an idea as to where government policy is going to go, so you know how to invest. You may have some idea which will really help on decarbonizing, but if there isn't the right policy framework and you invest in it, you lose out badly. So, when are governments going to just say this gap is so big that we have to do something? Now, within the Paris Agreement, there's a 5-year ratchet mechanism. Every 5 years, they do a stock take to look at how big the gap has got, and then they go around the table looking for countries to pledge to tighten their restrictions. And the good news at the moment is that China recently pledged net zero by 2060, and in the last week, both Japan and South Korea have pledged net zero by 2050. So governments are saying they're going to do it. Things are going to happen. Now, if you are a business, how do you prepare for that? And I believe the answer comes in the form of the Task Force for Climate-Related Financial Disclosures framework. And what's the inevitable policy response going to look like when it happens? What's the impact going to be? So when governments suddenly say, right, we are going to drastically change direction, well, part of what's going to happen is the trends which are happening anyway will happen sooner. So Hendrik, you may think you've got until 2035 or whatever to continue to burn coal. Maybe the government suddenly say no more coal within a much shorter period. Or the people who are involved in cars, they say, well, there are some countries which are saying no more internal combustion engine cars by 2040. Maybe that comes much sooner. One of my favorites, or the things that I think that cruise liners are incredibly carbon intensive. I personally think they should all be scrapped. That's my personal view. So if you are a business and you're involved in one of these carbon intensive discretionary activities, you need to be thinking about how is it going to change. Now, this is Mark Carney talking in 2015 about this Task Force for Climate-Related Financial Disclosures. And the way in which he introduces it is to talk about the tragedy of the horizon. Now, a tragedy, in the Greek sense, is a really bad thing that you can see is going to happen, and somehow you can't do anything about it. The institutional framework you're in, you just keep going towards the tragedy. And with businesses, businesses often have a relatively short time frame they look at when they're doing investments. Is this going to pay back within 10 years? So I don't need to think about what happens more than 10 years' time. So they don't consider the long-term adverse impacts of the stuff they're investing in. And the solution to that, which is proposed by TCFD, is to start doing scenario planning, looking at possible future worlds under different emission scenarios and thinking about how would your business cope with that. So this is something which has really high level of support. It came out of the last financial crash in 07-08, when at the same time as the governments, the G20 governments, set up the measures to stop the world from going into depression, they also said, why didn't our experts tell us the problems were going to happen, the subprime problem was going to happen? What can we do to make sure that we're told next time there's a systemic risk building up in the financial system? And they identified climate change as something which could have a big impact on company values, and they set up this task force chaired by Bloomberg to solve it, and it's into identification and management of climate-related risks. I strongly recommend you watch the video of the speech which he gave. And this is the framework which they came up with. So on the left, you can see the different types of risks. You have transition risks and physical. So the physical we sort of know about. You know, we know about typhoons, we know about sea level rise, we can sort of see that coming. The ones which are more scary from a business point of view are the transition risks, the possibility that the governments will get their act together and will, in very short time scale, put in regulations which, my example, bans cruise ships. So the idea is you look at your business under different scenarios and see which of these risks might appear. At the same time, on the right side, you're also looking for opportunities. If you see the world's going to go towards zero carbon electricity rapidly, then investing in more wind farms and solar farms and so on is great. And you feed all of that into your strategic planning, you work out the financial impact, and it goes into your business plan. And to talk about the scenarios, so this is something which Cambridge University did in terms of, you know, just a picture of what the different scenarios might be. So on the left, you've got the business as usual scenario. We basically don't have any policy change, and the world heats towards +4 degrees, and in that world, adaptation becomes really important for the business because we get a lot more climate change impacts. And then on the far right side, you've got the aggressive mitigation, where there is really rapid policy work done to get us to net zero, and there you have a lot of transition risks. You know, the people, I mean, Bosch, for instance, has laid off staff in the last few years because of the reduction in diesel engine cars, which they put a lot of components into. So as a business, you look and you see what would happen to you under these different policies, and then try and work out a strategy which will match that. And an example of a company that's further ahead than most on this is Lend-Lease, which is a big property company in Australia. And you can see at the bottom they've got their 4 scenarios running from resignation, which is the we can't do anything, business as usual, onto the far right, transformation, where there is rapid decarbonisation. And to give one example of the scenario, for the scenario 3, which is aligning to the Paris Agreement, and they say 2 to 3 degrees. I mean, Paris says it should be below 2. And you've got a timeline going down there as to different things that they can expect to happen under this scenario, and then they can start to think about this for their business. And this is the detail, some of the detail that's in their annual report, where they're talking about in 2018 they committed that they would do TCFD. In 2019 they developed their scenarios. 2020 they ran a whole series of workshops where they got the top, I think it was about 200 or 300 people from the company together into workshops discussing how their business would fare under different scenarios. And on the right here you can see the timeline that they've stuck in their annual report as to the things that they have already done and the steps that they need to do. So it's a long journey. This is not something you do quickly. And to take a graphic from the UNPRI's report, which came out in June this year, talking in more detail about the inevitable policy response, you have the getting started phase, determining influencing factors, utilizing specialist tools, and then identifying the responses. And the questions I put, you know, if you're a company, and I asked Hendrik this, where is CLP on this journey? You know, have they got to a point where they've got scenarios and they're publishing them in their annual report, or are they somewhere behind that? Because CLP is probably as far ahead as anybody in Hong Kong on this. And investors, where is the company you are invested in on this journey? You know, because a company that's doing this work and reporting it will have thought about the risks and be prepared for them. So it will actually be a lower risk company than one that's just being quiet about it. And everybody. What about our government? That government delay means that when the change happens, it's got to be more drastic and it's more painful. So why isn't our government doing anything?
Okay, great. Thank you very much, Robert. Maybe I can hand over to Chani and give us a few insights from the capital markets on this issue.
Yeah, absolutely. Thank you so much. And first of all, I really want to thank the organizer for having me here. This is my first in-person event since the outbreak. So I'm really amazed to see how many people are here. So thanks again. It is really alarming, and like Robert just mentioned, it's inevitable. So how does the finance sector, both banks and the capital markets, respond or prepare for these alarming risks? Take BNP as example. We are one of the very few banks that have made a very clear exit towards fossil fuel for the reasons that Robert just mentioned. Physical risk, transition risk, these can translate into liability risks, to a bank. So since the Paris Agreement, we have stopped new financing for thermal coal companies. And very recently, we accelerated, the ambition by setting a very clear exit timeline. So it's not about just not funding new companies, new clients, but existing clients, we also have made very clear exit timeline. So by 2030, for OECD clients, there would be no thermal coal in our portfolio. And for non-OECD, that's 2040. That really shows how the bank is walking the talk when it comes to climate action. And apart from not doing business with certain segment of the economy, we also look at the opportunity side. So we are reallocating our capitals to support business that are from the renewable energy space, at the same time that are directly linked to the UN SDG. So since then, we have doubled our project financing to renewable sector. And we have put aside at least or committed to finance at least 15% of balance sheet would go to companies and activities that are directly linked to the UN SDG. Mm-hmm. So, that's what the bank is doing, in responding to climate change. In the capital market, and I think that's actually, a very important space because the bank or each bank would have their limited, balance sheet to support the economy. But how we utilize the capital market through working with investors around the world, we are talking about trillions of assets that are looking for investment opportunity. And I think that's a very powerful leverage that we can use. So I spend a lot of my time working in the green bond space, working with clients to articulate, their green bond program or sustainable bond program, and link this origination of projects and assets to investors who have an appetite to support these kind of instruments. So the market is currently over $1 trillion outstanding in terms of issuance. And in 2020, year to date, we have seen the surge of sustainable bonds at $370 billion equivalent, way surpassed, the 2019 as a full year. So we are seeing, the sustainable bond market going from strength to strength, and with, dedicated proceeds to support a wide range of green and, social, projects and assets. And green bond is certainly the biggest segment of the whole mix. And if I look at, the use of proceeds behind these green bonds, renewable energy, energy efficiency, low carbon transportation, and green buildings. Yes, these are the top four use of proceeds that are directly linked, to climate change mitigation, adaptation, and resilience.
Okay.
Thanks.
Great. Thanks very much, Shani, for giving us some examples. If I can hand over to Hendrik to give us a few words about CLP's journey.
Sure. Thanks very much for having me, first of all. And I agree very much with the comments that Robert and Shoni had at the beginning here, except maybe that the electrification of transport is something we need to keep in mind when you go on your next cruise, hopefully. there'll be electrified cruise boats out there that we can all take and not feel so guilty about the emissions that come from your holiday. I'm really struggling with this mask thing. So, I mean, this is my first in-person event as well. I did have to opt for Zoom meetings previously when someone asked me to come in and speak because I couldn't do an hour and a half of masking and talking. But anyways, I'll give it a try. For CLP, and maybe just to respond and put into context of how we respond to climate change and what has been really at the forefront of the organization for well over a decade. Back in 2007, we had launched our Climate Vision 2050 for the first time, really making commitments in terms of carbon intensity of the electricity that we deliver to our customers, all the way with intermittent targets to 2050. Now, that was updated over the years in 2010, and again, most recently in 2017, where we also then added renewable and non-carbon targets, including for 2020 and 2030, and committed to a carbon intensity reduction of 80% by 2050. And at that point, we were, okay, we have new targets. We need to update our climate vision. We need to release a new document on that and tell our stakeholders how we intend to achieve these targets. And that was released back in December of last year. But the writing and the whole drafting process that stood behind that was actually a much longer process, probably longer than setting the targets themselves. Because as we went through the various markets and our commitments that we have in terms of the assets and our coal assets we still have, yes. We have a mixed portfolio of renewables, coal, nuclear. It became quite apparent at some point that as we go towards 2050, yes, we need to accelerate the phase out, but we also need to make sure we don't add anything into our portfolio that is not in line with our climate vision. And that really triggered a long discussion at the most senior level of management and then at the board level about two investments that we still had in Southeast Asia and whether we should pursue those going forward. And it was decided that we would then really opt out of these projects. So we made a commitment to not just have no coal by 2050, but to not add any additional coal by 2050. And the other piece that really came through with this updated climate vision was a clear trajectory that we published of how our carbon intensity will change over the years, and putting that side by side with the Science-Based Target Initiative decarbonization pathway that would be expected for an organization such as ours. And again, and it's just the transparency that we operate under and that we strive to operate under as an organization. It was clear there's a gap. We acknowledge that gap. We are good in terms of 80% reduction by 2050. We are not net zero by 2050. The challenges here that we have is that we have market constraints, we have regulatory constraints, we have technology constraints, and we have an obligation, we have a purpose as an organization to keep the lights on at the same time. So we have to balance that out, and we can't really, as an organization, set ourselves targets that are that we should have perhaps. They're ambitious, but we don't know yet how to get there. So that's really quite important, and I think that's also quite different from what many other organizations have been doing recently, in particular the last couple of years, of setting net zero targets, ambitious net zero targets, including now the governments coming in, Japan, Korea, China, 2050, 2060. Okay, it's great, make the pledge, but how are we going to achieve that? And the power sector really playing an important role in that, and we want to be supportive of that. And for us to also really deliver on that, we need regulatory clarity in terms of what are the expectations from us as an organization, and how can we then deliver that to everyone. So that in itself is sort of the background in terms of climate change and TCFD and the whole story behind what you presented here. We think it's great. We're responding to that. We're working with that. But we've been working with that space for many years already. So we're glad it's here now. It's here for everyone. We're not sort of the lone company here in Asia or in Hong Kong that is pushing this, and everyone else needs to do this as well, absolutely. And the scenario analysis piece being an important component of that.
Okay, thank you very much for kicking us off here. The purpose of having the three perspectives is so that we can share examples. Should we say the urgency of addressing the climate change gap is really critical. The purpose of our discussion here is what examples can we use? What drivers are out there to help us push the agenda so that we can close this gap between our understanding and action? So where I'd like to start is the topic with the TCFD. So my first question will be to each of you. If you wouldn't mind sharing your thoughts on, as a reporting or a disclosure framework, do you see the TCFD actually being different? Is it actually going to help push the agenda? Is there enough excitement around the bringing together of the financial language and the ESG sustainability reporting in such a way that we can actually move from efficiency gains to actually driving absolute reduction? Can this actually help us, considering that since 2013, we've had more than 300 ESG type reporting disclosure frameworks? So are we muddying the waters for businesses and investors, or have we actually reached a point where there's going to be more clarity on this? Maybe I can start with you, Robert.
So the thing that's different with TCFD is it's asking companies to think about the future 15 or more years' time and to report on it, to talk about it. Companies are happy generally talking about the history, but to talk about the future stuff, what if they say something and they get it wrong and they're going to be sued, they're going to lose reputation. So having a framework which basically forces companies to talk about the future is really important. Two other things that need to go with it. One, for each company to invent their own scenarios is a lot of work. And when you get the reports, they're going to be different because they're going to be against different scenarios. It would be much better if there were, for each sector, a sort of globally available scenario which companies can pick up and use rather than them having to invent their own. And that's one of the areas which work's needed on. Another one is what I would call safe harbor provisions. If you go and make future-looking statements within a certain context, you are regulatorily protected from being sued. Because we need to get an honest discussion out there as to what the issues are, what the risks, in order to be able to talk about the problems that are come. And if we talk about them more, then maybe we'll do something about them.
I think to me, TCFD is not just a reporting framework. There's a lot of risk management elements, within TCFD, and I think that makes it different from the 300-something reporting frameworks out there. So BNP released their first TCFD report some time ago. And this is the first time where we actually use the entire TCFD approach to look at the governance of ESG matters, and most importantly is the scenario analysis aspect. So we're looking, for example, there was one, you can actually see online, but there's one section where we actually look into how exposed we are as a bank to our to climate risk scenarios, looking at different sectors and our top clients within each sectors. So we actually score each of these assets accordingly to come up with a conclusion what we need to do to reflect in the way we bank with our clients, in the way we rate the credit exposure, and translate that into internal pricing for the bank. So I think that's actually a very key element that other reporting framework has not done. So and like Robert said, or you said, that we are putting our peers on the same path, with a similar approach, so that you can make more apple-to-apple comparison between one bank to another, looking at how they are implementing or taking action, to climate change. So I think that's actually very, very important.
Okay, great.
From our perspective, we very much embrace TCFD, as it does have those components that are fundamental, starting with the government side, and then strategy, risk management, and then the metrics to measure all this. But I guess what's really quite important, and I agree with the risk side, this is really fundamental, but it's not just about identifying the risks, but how do you see your business change over time, and what sort of opportunities do you see coming your way? And are you prepared for these opportunities? Are you adjusting your business for that? So it really creates that thinking internally on the risk side, and integrating some of these components into your risk register is really quite essential. But and we're doing that, but I think it comes to a point where there's other key issues for an organization that are also equally important. It's not just about climate change. It's the framework from TCFD that's so really valuable, and it could be replicated for other issues as well. Mm-hmm. And to go through that process of, do you have the governance to manage the risk? Do you have a strategy, and how do you see your market change in response to that over time? The scenarios piece, and envisioning, or having a crystal ball and what's 2030, 2040, 2050 going to look like for your organization is very, very difficult. I mean, you can put 200 people in a room and try to figure it out, but you can have another 200 set of people in another room, and they'll come up with something completely different. And that's where the scenario sort of convergence has to happen, and there's work being done on that, where then everyone uses the same type of scenarios, at least for comparability, and also to make it a bit simpler for organizations to have that some sort of guideline of what the future could pan out to be. If it's a 1.5 degree world or 4 degree world, it has very different impacts from a physical risk perspective or a transition risk perspective. And there's work being done on that, and we are also joining another working group with WBCSD that is working for TCFD on this, on developing scenarios specifically for the electric utilities. We had previously worked with them on a prepare form to just sort of have a broader framework for electric utilities, and this is being replicated for other sectors as well. So there's a lot of thinking happening still on how to really optimize the reporting framework. But the challenge really remains is, at the end of the day, you have scenarios, you have a vision of the sort of risks that you're facing and the opportunities that you're grasping, but ultimately what TCFD is asking for, what's your financial value at risk? What is the financial implication of all this on the business? And that's what the investors are asking, but no one really knows how to do that just yet. And to put out numbers into the market that are very much forward-looking, with a lot of assumptions behind it, it makes any CFO a bit jittery, I think. And it is something we are working on, and it is something that I think we would encourage anyone to work on. The challenge, though, is that some of these rating agencies, we talked about rating agencies, there's so many of them, they're now coming up with products that will literally put a number on your company, whether you like it or not, in terms of financial value at risk, without having done perhaps the level of the level of analysis and the depth to the analysis that should be required in order to come up with a figure in the first place. So it's best to sort of take the lead on this yourself, figure it out yourself. Whether you then disclose these numbers is entirely secondary for us, if not tertiary even. It's really about the value at risk we see, the risk opportunities we see, and managing those risks going forward. And then from there decide whether the value we see, the financial value at risk, is that something we want to share with the market? Do we see those numbers as being credible? And that's work in progress for us.
Okay, that's great. Thanks, Hendrik. I don't mean to put you on the spot, actually, but I just wanted to follow up on something you said. And I think this is something that reporters in general will struggle with, and that is, it's generally capturing or getting people to react and do risk management. So this idea of, is it the nature of where businesses are primarily, they're still in a risk management reactive mindset? Or does TCFD and the likes of what's happening here with this kind of reporting, you mentioned that it's illuminating opportunities. So we're looking for forward statements, we're looking for an idea of what businesses are actually going to do about their risks and move forward. Would you be able to share an example of going through this process? As you identify risk, you put a financial price on it, what kinds of opportunities have you come across? Have you had aha moments through that process?
Yeah, well, I mean, without being too specific, but I guess it's really about the time frame fundamentally. That's really so different here in terms of envisioning a future that's 5, 10 years out at least, versus your more traditional risk register that looks at operational risk within the next 6, 12, 18 months, maybe up to 3 years at most, depending on the nature of your business. So for that, it becomes a strategic discussion, and that's where the scenario analysis sits under TCFD. It's under strategy. So how do you see your business evolve? And for us as an electric utility, it's all part of being part of the energy transition, moving away from carbon thermal assets and using thermal combustion as a means to create and generate electricity. There's a transition undergoing where we have different sources of generation, but also just if you look at this building and this very new building, there's so much energy efficiency built into this that there is opportunity here for us as an organization to even provide services around that. So it's thinking along those lines, and where's the new business opportunity for us within that transition? And it really triggers some of that thinking.
Right. No, thank you. And we'll come back to sort of the ESG ratings, actually. I have a question later on that one. I don't know if Chowny or Robert, you'd like to address that in terms of, are you hearing a change in the conversation from sort of risk management reactive to being more strategic? Are the conversations changing?
I think so. I'm an optimist. When we work with clients, we did actually see the change of mindset over time. In the past, it's very much like, some of the investors are asking me to do X, Y, Z. But now it's about how can I improve my ESG performance, my climate strategy, in order to attract ESG investors. So our corporate clients have moved from a very reactive, approach, passive approach, to now increasingly more proactive. So they do see the value of ESG and climate, preparedness as a way to get investors to put their dollars, into their equity, into their fixed income, assets. So that's, I think, very important in how corporates are now thinking, these aspects. And CLP is a perfectly good example when we did a transition bond, with the company earlier this year. Another change, from the bank, itself, is how we are taking the outcome from TCFD, as well our commitment to think about how we bank with our clients. How do we work with them in the capital market space? So it's one thing to say we don't work with these kind of clients or these kind of projects, but we need to move our capital from that part, brown or dirty, to green, transition and greener and more sustainable business. So we are actually going through a very rigorous process right now, reviewing all our utility clients around the world one by one to understand if they have any climate transition strategy in place. To what extent, their coal, asset is as a percentage of their portfolio. Are we optimistic that they can move, away from coal by 2030 or by 2040, depending where the location the clients are. So that's actually a very painful process for a bank. And you actually have to say no to clients, to business, and walking away from these deals that, some peers may take it. So it's a rethinking of the allocation of balance sheet, our strategy, and how we see our clients are transitioning, in the next 10, 20 years.
Okay, thank you. Robert, do you want to add?
Go back. So, where's the big uncertainty? Is it in the climate science? The answer is no. The big uncertainty is when governments are going to take regulatory action and the extent to which business is going to anticipate it and get ready. These different scenarios, they're all ones which are sort of there per the science. The difference between them is the extent to which government and business has taken action. And we need not just to look, the near future in terms of getting out of coal, but vent to atmosphere gas burn in Hendrik's history is not going to get us to zero. It gets us to 0.4 kilograms of carbon per kilowatt hour. So we've either got to have carbon capture and storage, or we get rid of gas burn, and we have to go to a combination of nuclear and renewables. Buildings. To me, the focus tends to be on the power generators because they burn or they get all the emissions directly. But the cause of them producing electricity is us using it. So buildings. This, I think, is probably a very good building, but I've got no idea. If you go into a hotel, you can see it's a 5-star hotel or a 1-star hotel. What star building is this one from an energy efficiency point of view? We don't have that metric out there. In Australia, they do have one like that, and it does have an impact on what's built and the market. So that's one thing that I do think we need in Hong Kong, is a specific energy consumption per square meter driven metric, which tells us just how good different buildings are and motivates building owners to build more efficient buildings.
Okay, great. I'm watching the time, and we will open the floor to questions shortly. I have one last question that I've always wanted to ask, actually, and get a cross-section. It's a little bit long, bear with me, but it's moving us towards thinking positively, and how do we actually build capacity? We clearly know now that we have to have the inclusion of climate matters in financial reporting. So, however, nowhere in financial reporting disclosures are social and environmental impacts captured. So the current system does not capture causal relationships between social and environmental performance and economic results. So in addition, current disclosures do not capture the positive impacts from adaptation and resilience initiatives, such as the drawdown projects, like reforestation, regenerative agriculture. So that's one of the other key areas. We focus on transport and buildings, but we rarely actually look at agriculture and regenerative agriculture, nor the co-benefits of community finance projects or even mangrove restoration. So can we actually capture that? That's a positive that businesses are actually investing in, but yet it's not measured or disclosed in their economic performance. Let's add another piece of the confusion, going back to the ratings, and that's from the many ESG ratings providers where the correlation between them is actually found to be quite low. And that's because each of them have their own definitions of the socially and environmentally desirable behavior, and therefore they weight the data differently. So we add confusion now to the number that you mentioned earlier, Hendrik. So with this in mind, how do we help the investor or any assessor of company performance get beyond general proxies of risk to rewarding those companies that are embedding sustainability and meaningfully addressing the wider implications of adaptation and resilience to climate change? What are some of the things that we can do to help reward companies for actually investing in mangrove restoration, regenerative agriculture, kelp farms, all these things that we're reading about now that actually help with mitigation, adaptation, building resilience? We need to reward the companies. Is there a way of doing that? And can we inherently capture that in these disclosures reporting frameworks that are helping to drive the agenda? Your thoughts, your collective thoughts. That's a big one.
I mean, the answer is yes, carbon price. And prior to getting carbon price in real money, shadow carbon price. So to have a company work out if it was paying a carbon price on its emissions, what would that do to its financials? If you've got say you've got an operation which is growing mangroves and sequestering carbon very nicely, what would its financial result be if there was there? So shadow carbon price is the easy thing to do, and hopefully if we get the shadow carbon pricing working well, then we can move on to from there to actual carbon price.
I'll give an example. And I'm going to be honest, it's very hard when it comes to, the aggregate sector, because unlike infrastructure, they are large scale, they're bankable, and sometimes overbanked. But when you are in, comes to agriculture, particularly community-based, agriculture, they are very, very small. So it makes, banks like us perhaps not relevant to support it. But so it requires innovation in the structuring of this kind of potential. So we did a deal a couple of years ago in Indonesia, looking in a plantation. And the project is actually using degraded land to regrow, to regenerate rubber tree for various manufacturing purposes. But the interesting, what makes us interested in that project is that there's, it is an approach to prevent further deforestation, in Indonesia. And there was a really large area of land that we were talking about that was degraded for a very long time. So no one was regrowing anything. So we worked with a number of partners to make that project bankable. We work with USAID for the credit, partial credit guarantee, so that we can manage, credit risk, from the bank side. We work with ADM Capital Foundation, as well as WWF, on the sustainability elements of the project, because we do not want it to be another plantation project where you don't really see any sustainability benefit. So there was quite clear environmental and social safeguards regarding how they regrow, and also the labor and human practices to the workforce, working, in the plantation, as well as, their families. So that was actually a fairly small project, compared to a lot of projects that we do. That was $95 million project bond that we issue, with USA partial guarantee. And then we divided the project bond into various tranches depending on risk return profile, in order to attract impact-driven investors to come in to support, the bond, so that we can provide the capital to the project, on the ground. But like I said in the beginning, it's very, very difficult, to make it bankable, and it requires, 2 years, in the making, which is, a lot of time invested in making this kind of project. But certainly, we think, the blended approach, blended finance approach, is critical to scale up similar type of projects.
Okay, thank you. Andrew?
That's a very long, complicated question.
Sorry.
I hope you don't put that into your exam questions for your students. That'd be very difficult to answer. But I think what you're getting at is sort of about, it's more about impact measurement to some extent. And if there's any sort of correlation between a company's performance and its impact on the outside world.
Yep.
We, as a reporting organization, we take the other view, and I think this is really what's also come through TCFD so nicely, is that what is the outside world's influence on us? And how do we manage that influence, and if you like, the risks, and what sort of opportunities come our way? And then through that process, how do we transform our business to respond to that in an appropriate manner? So there's really a lot of sort of opportunities to identify how a company can really do the right thing at the end of the day. So it's the outside influence, the impacts on the organization. What is it that we need to do to do better? So it's from that premise that I think it's quite important that you then identify the material topics for your organization. What are the big impacts that are influencing you? How do you respond? And then through that process, respond with a new strategy, with a modified business plans. And then accordingly, if you have an organization that has the right leadership and believes in doing the right things, having a reverse positive impact on the outside world. Mm-hmm. And that in itself, so it's about really understanding what's pushing you as an organization, and how do you respond to that, how do you manage that in a good way, and then that leaves you ultimately with an organization that is actually having a positive influence and trying to solve some of the issues we've been discussing today.
Yeah, and what's pushing, but what's pulling as well. Perhaps what's happening out there, the opportunities that actually can pull the company in that direction as well.
Yeah.
I'm just looking at the time. We have time. I don't have the iPad, but is there, we can entertain a question from the floor for one or two of our panelists. I think Felix, your hand went up. Do we have microphones?
Thank you for your sharing, giving a lot of insight on climate change. My question is simple. You have discussed a lot of stakeholder, government, company, investor, and also consumer. Among all those stakeholders, what do you think? Who should be the leader to accelerate the climate change? And do they reliable? Yeah, because climate change might not be their priority.
Anybody want to jump on that one? Who needs to lead?
I think we all do. I mean, I think the video at the beginning said business needs to lead. But in order for business to lead, consumers need to help, governments need to respond. We need to have the right forums for discussion and how to solve problems. It's not a one-way sort of, one group sort of fixing it all.
No, absolutely. We're faced with, it's a complex problem. We can't break it down into simple sound bites. It means that all parties, we've contributed to the problem. We all need to step up and do something. It's a question I think people are struggling with, the how. What is the piece that I can actually do? And I wonder if we can go back, just really quickly, this is just my comment, and Hendrik, you're saying what's pushing companies. But what's also pulling companies? How can we actually, as a consumer base, reward companies for doing the right thing? There's a lot of shouting out, obviously, when they do the wrong thing, and that's good that we have that. But how about we give a shout out to the companies when they're doing the right thing as well? I think that's equally important when they're not currently being rewarded in their economic performance for investing in regenerative or resilience or adaptation type projects. That would be my quick sort of answer. If maybe Chani or Robert, you'd like to, sorry.
You said it so well, there's no single bullet, everyone has to act. Certainly, in our case, we started voluntarily, with our policies, ambitions, and now we're seeing, the regulators are pushing, the finance sector. And I think that's really important because now you put all the banks or financial institutions on the same path. It's not just one organization. We make little difference.
Mm-hmm.
And my answer is it starts with us. We need to be thinking about what's needed, and we need to be talking about it. We need to be lobbying our business leaders. We need to be lobbying particularly the government. If the government feels that the public wants the regulation to go in a certain direction, then it's much more likely to happen. Once government sets policy, then business can act. So business, in the end of the day, is going to do the heavy work, but it will only be able to do it if the government sets the policy, and the government will only set the right policies if they get acceptance pressure from the public to do it.
Great, thank you very much. We're getting the numbers blinking. So we have to wrap up, and thank you very much, Robert, Chani, and Hendrik, for sharing with us today. I hope that this sort of starts a conversation. It doesn't stop here, and that we keep going and keep asking these questions. Enjoy the rest of the day, and thank you to our organizers.